Hello, this is a kind of quick overview of the slide deck that you would have received, or the handouts. Notice that the third homework is due this Wednesday or Thursday, that the homework over inventory is due the 27th or the 28th, depending on your class. And if you have a conflict with the second exam time, to make those arrangements now with ADSR or with myself and the BBA office if you have a schedule conflict. There's all different types of inventory, from commodities like jelly beans to unique items like diamond rings, and how we account for them and how we cost them out differs depending upon what the item is that we're offering for resale. The big question with inventory is, how much does it cost? Once we have the cost, there are other considerations. We may need to write that inventory down to the lower of cost or market. And also there's a lot of costs involved in tracking inventory, from income taxes and how it impacts your current ratios, your liquidity ratios, to how much does it cost you to keep the books, to the idiosyncrasies of it, like LIFO liquidation and inventory purchasing practices can help you manage your earnings, as we like to say, and how inventory can impact compensation, and how do you get that bigger bonus. Also, it impacts your ratios, specifically those that have to do with the income statement and your liquidity ratios, such as the current ratio. Where does inventory show up? It shows up in two places: on the income statement via cost of goods sold, and as a current asset in inventories. This is Coca-Cola. Coca-Cola also must disclose what the inventories consist of, if they're valued at the lower of cost or market, and what inventory method we use. In this case, we use average cost, or first in, first out, known as FIFO. In addition, we have to disclose all of our different types of inventories and their dollar amounts. Contrast that with Walmart, and if you look at Walmart's inventory pretty much takes up all of its current assets, and its cost of goods sold they call cost of sales in the income statement. So inventory plays a large part in Walmart. Walmart also shows on the statement of cash flows the change in inventories when we're computing cash from operations. Notice that Walmart also must disclose the inventory method. Notice they use LIFO, last in, first out, in the United States, but internationally they use FIFO, first in, first out. And the other thing is you have to disclose you're using the lower of cost or market. And if you use LIFO, you have to also disclose what inventory would be if it had been computed FIFO instead, and that's called the LIFO reserve. As far as the anatomy of the accounts, if we're under a perpetual system, which means we have a barcode and you scan every time you sell something, you have an account called inventory, and everything flows in and out of inventory when you buy it and when you sell it. But under periodic, where you have no barcodes and you physically must count the inventory in order to know what the beginning and ending inventory balances are, notice we have an expense account called purchases, which tracks the buying and the returning of your inventory purchases during the period. When we compute cost of goods sold, that happens under periodic. We have to compute it, remember, whereas under perpetual, cost of goods sold is an account or an expense, cost of goods sold. Periodic, there is no account. Let me pause here, and then we'll go through some problems.